The Rebel Capitalist Show.
I was reading a story in the Wall Street Journal where they were talking about how higher mortgage rates really affect new home buyers. And I hadn't really thought about that, but they outlined in this article how new home buyers usually buy the house prior to it being built.
Right.
So let's rewind to 2021. If you're the average Joe and Jane first-time home buyer, you're out there putting down a $5,000 deposit on this house that will be built in the future, and you're calculating what your mortgage payment is going to be based on, let's say, a 3.5% interest rate.
Yep.
Well, fast forward to a year where now all of a sudden you've got to buy the house and interest rates or mortgage rates are at 5.5%.
Yeah.
And you can't afford that payment anymore.
Right. Then the media is going to report on this, and a lot of people are going to say this is the housing crash. And I think they're mostly wrong, and here's why. So what you said about the new home builds, that construction cycle is taking longer and longer because of the supply chain problems.
Right, they mentioned that too.
Yep. Yeah, because of the labor shortages and all of that. So, they might have built that home in 6 or 8 months before, but now it's 10 months, 12 months, 14, 16 months. Okay. So that problem makes this interest rate problem even worse, because that most buyers go out, especially first-time buyers, and they buy the maximum house they can possibly qualify for. But they were qualified at a 3% mortgage. And they can't lock the mortgage in for as long as the construction takes. Right. So they're forced to cancel. And there's going to be a lot of these. I mean, over the next 6 months, 8 months, 10 months, we are going to hear tons of stories on this. The media is going to report on it like there's a housing crash. But what I've been saying is people need to look up. They need to look above. And what do I mean by that? Take the example. A first-time buyer, a young couple goes out, they qualify for a $350,000 house. They buy the house. The house takes a year to complete. Now they're forced to cancel the contract because they can no longer qualify. And so they are left sitting in the renter pool. They never got a house. They're just stuck in the renter pool, which puts upward pressure on rents. So that's good for investors, right? But then what happens? That house doesn't remain unsold. Simply the person that bought the $450,000 house also has to cancel, and they move down a rung and they buy the $350,000 house. Now, this makes a lot more work for the home builders and the real estate agents for sure. But the fact is, that's what happens. Everybody just moves down the socioeconomic ladder, and they simply are forced to adjust their expectations with the economic reality. The first-time buyer stays in the renter pool, everybody else moves down, and a good question to ask, well, what happens at the top of the market then? And the answer is, I don't really know, because it's just kind of complicated. And in the higher end of the market, people aren't always buying the maximum they can qualify for. A lot of times those are very wealthy people that, they're paying cash, or they could buy much more than they're actually
I think that's
buying.
when it goes back to stocks.
Right, yeah. Yeah, right, because they're more in the stock market.
Yeah,
Sure.
absolutely. A much higher percentage of their net worth is in their 401k or in the S&P 500 or the NASDAQ.
Yep.
Like what would make you say, you know what, I was very bullish on rent prices, now I'm getting a little bearish?
Well, the more the housing market softens, now, it's got a long way to go before it softens, but say it softens, say interest rates go up a lot. Okay, and we see much higher mortgage rates, which reduces housing affordability. That simply forces people to stay in the renter pool, and that puts more upward pressure on rents. So it's kind of counterintuitive to some people, but people that own a lot of real estate and have good mortgages and good debt structures on those properties, they actually like high interest rates because their rental yields improve. And that assumes they're not continuing to build their portfolio, right? So say someone's an investor who's done really well. They've got 100 single-family homes that they own. Okay, we've got one client now that's got about 130 that they bought through our network, and he wants to get 500 houses. And if they've got that and they say, hey, 100 houses, that's a lot. It's more than enough. I'm just going to sit tight and I'm just going to manage my properties and have a yield. If interest rates go to 10%, no investors are going to be entering the market, right? So, or very few, right? Prices would have to come down a lot to offset that interest rate increase. And they're going to see massive upward pressure on their rents. And similarly, when the housing market is super hot, you usually see downward pressure on rents.
Yeah,
Now,
but that's my point. Usually there's an inverse relationship
yeah,
between rents and prices. But what we've
right.
seen since really 2012
Yep.
is they can both go up at the same time. Rents
Agreed.
and prices. So my point is, if they can go up at the same time, then I think they can go down at the same time. It's definitely possible.
I don't know about that. And here's why. Here's the difference from the 2012 mark. And I was just about to mention that. And that is that there is a housing shortage. So we've had such a construction shortfall over the last 10 years that we've seen both go up.
Yeah,
now,
but let's
granted,
take it to an extreme. If
yeah,
we just waved a magic wand
right.
and took Fed funds from 75 basis points to 10% tomorrow,
Mm-hmm.
I guarantee rents would come down.
You think so?
We would go into an economic depression like you can't even fathom.
Well, okay.
It would make the 1930s look like a picnic. And what
Actually,
would happen is
that's a good point, because
the stock market would come down, crypto would crash, the housing
unemployment
market
would skyrocket.
Oh my gosh, unemployment would be at 35%. And that's the way the government measures it. Probably U3 would be at 35%.
Yeah.
So in that
would be
case,
terrible.
We got prices coming down and we got rents coming down. And I think what would give there, Jason, to your earlier point, would be people's standard of living. You'd just have more and more and more people packed into that 650-foot apartment.
Right.
That studio apartment that one person used to rent before, a college student, now would house a family of 5 or a family of 6. And that's exactly what I see in South America.
Yeah, that's exactly true. George, I wasn't talking about it in the sense of the broader economy. When you talk about it like that, you're absolutely right. I'm just talking about, normal interest rate increases and what happens to the market where they're inverse, like you agreed. But if we have overall economic collapse with a dramatic shift like that, yes, I mean, really what's going to drive that more than anything is massive unemployment.
Right.
That's right. It's the unemployment issue. It's not even stock market crashing, crypto crashing. It's unemployment. That's the problem.
Yeah. And see, that's where I think, and again, we're talking about probabilities here. And although this scenario that I'm outlining may be possible, the probability might not be that high, but you got to ask yourself, what is the probability of headline inflation? Or I would say it even a different way. What is the probability that we go from a labor shortage to a labor surplus?
Mm-hmm.
And what would make that happen? Right. Because I don't think it's just about the unemployment rate, because the amount of people in the workforce, or the labor force participation, is very, very low. So that artificially adjusts that unemployment rate, where if labor force participation goes from low to high, then you could see a labor shortage go to a labor surplus, which would increase dramatically the unemployment rate, which would lead to an environment that we are referring to. And I think the big thing that would make that happen is if asset prices really take a hit,
right.
most specifically the stock market.
Yeah, and there's one more thing we should say that could make that happen, where rents and prices decline at the same time, and that is an oversupply of housing, which is very unlikely. But if the builders somehow catch up, or if there's somehow some new construction technology that makes construction easier, cheaper, faster, of course, some disruptive technology, and that's kind of what I like about real estate. It's pretty primitive, really.
Yeah, right.
There's not, unless we're all going to live in a force field or something, it's not likely to change too much. That houses are built out of sticks and bricks still. That would also cause a problem.
Yeah, the supply is very, very tight, and aggregate demand would really, really, really have to come down for nominal prices to really start to decrease. I think the only variable there on that supply side of the equation is the amount of housing stock that's owned by these large funds
Right.
that are completely agnostic when it comes to what assets they hold in their portfolio. And if they're getting a 5 or 6% return on their rental properties, if they can get a 10% return in a 10-year treasury,
Right.
they're gonna shoot
They're
over
gonna
to
bail.
that. Yeah,
Yeah.
exactly.
Yeah.
Exactly.
You know what's interesting, George, and I have not studied this. I just haven't had time to look into it, but I have been thinking about it a lot. What I would like to know is what is their debt stack on the thousands of properties they own?
Yeah,
How
good
long
point.
is that debt? When does it mature? What is the rate? I know the rate's lower than a mortgage rate because they can borrow more cheaply than we can, of
Yeah.
course, because they just go to Wall Street. But
But it would be adjustable. It's not like they've got a 30-year fixed rate mortgage on all those homes they buy.
yeah, I don't know. I mean, interestingly, you can
Yeah,
get 30-year fixed rate portfolio loans from these private equity and hedge fund groups that are lending money like crazy.
but I
So
don't think even Kenny can get a 30-year. I think the longest he can get fixed is like 10 years.
10, yeah.
10 years on his debt. But
Yep.
who knows?
Yep.
Maybe Blackstone could get a different deal than Kenny.
Yep. Well, single family homes are also more generally considered more favorable.
Oh,
So
that's true.
I
That's
don't
true.
know.
Kenny's just doing multifamily, right?
He's doing apartments, yeah.